Welcome back, everybody. Russell Westcott. Hashtag JV Jedi. Tweet that out if you for you. Here with my good friend Mike Ponte. We've covered a lot already, but I honestly think this next two segments we're going to is going to be even better than what we've covered already. So we've covered his backstory, we've covered how to qualify people, we've covered your presentation, we've qualified how much, we've talked about how much we love our wives. Hashtag love your wife. or sorry, love your spouse.
Love your spouse.
Love
right.
your spouse. I need to probably be very clear on that.
Yeah.
So, and this next line of questioning is, Mike, you're one of the best operators I know out there. The way you structure your business, the way you're reporting, the way you set up your fee structure, the way you have all those kind of wonderful things. So first question is, how do you structure your joint ventures with people? Is it just a joint venture? Do you have corporate structures? Do you have LPs? How can you simply describe it?
Well, like when we first kind of got started, it was just a typical joint venture structure, and in a lot of cases, it's very similar. It's changed a little bit, I would say, as we got kind of more into the multifamily side of things. But right now, it is kind of a joint venture structure for our residential. It's still kind of the typical 50-50 split, and these are kind of past relationships that or past properties that we've had for decades, really now.
Right.
And then on the multifamily side, for every transaction that we acquire, we do set it up as a separate corporation.
Yep.
Under that corporation, they would be shareholders, which are our joint venture partners. So they would be shareholders of the corporation, and then our company would have a joint venture relationship with that corporation and manage it that way.
Okay, so the one apartment on 45th Avenue is a corporate entity.
Separate corporate entity, yeah.
Then I own it and you own it. Do you recommend that we each have our own individual corporations, own shares in that, or do we just kind of do it personally? We're shareholders personally.
You shareholders personally is
Right.
what it's done. Now, we have individuals that have a corporation under a corporation, and that's up to them. And
lots of taxes.
And lots of taxes, right? But that's up to them to manage that part of it. So that's kind of been the structure up to this point. We are moving to kind of more of an LP structure here, hopefully soon. But that is kind of the direction that we're trying to get to. But it's just been kind of the structure that's always worked for us.
Right.
And for a lot of our existing clients, they've become, I don't have thousands of joint venture partners, and I hope I never do, to be very honest with you. We have individuals that have gone and repeat business over and over and over again. This is a structure they feel very comfortable with. I'm comfortable with it as well, and that's the way we.
How many joint venture partners?
I'm going to probably say we have close to around 50 partners.
50, 50.
Yeah.
Okay, so that's a lot.
It is a
Just
lot.
to start, you probably don't want too many more unless it's under a completely different umbrella.
Exactly, and kind of references before, and I think we'll probably have this discussion as well. How to find these people and where to kind of, where to find these individuals and stuff. But for us, we are very referral based, and it's not like we're out there hunting for new joint venture capital. We have a lot of existing clients that we've worked with, and we're now at a point we're kind of doing a lot of refinancing. And that refinancing is just providing more capital to get into more transactions, which is wonderful, right? So that's exactly what we're looking at doing. So.
Okay, so corporate structure, individually own it, personal guarantees on the loan. Who provides the personal guarantees? Both? Or them or you?
It would be just the joint venture partners.
Just they provide the guarantee, and they put up the money. And what typical is your split on that?
Yeah, so for a split on our single family stuff, we'd be looking at 50-50 split.
Yep.
In our residential side, or on our multifamily, we'd be looking at 65-35.
65-35, 65 investor, 35 you?
That's correct, yeah.
Okay. There's no right or wrong.
No.
The only right or wrong, the wrong only is if it adds up to more than 100%.
Exactly. That's when it's wrong.
Or less than 100, right?
Exactly.
But you do some different things with the way cash flow is distributed.
Correct.
So what do you do specifically? So you have 35% ownership in the property.
Yep.
And so that means at the end, you get 35% of any equity appreciation. They get 65 after they get their money back.
That's correct.
What do you do on a cash flow basis?
So on the cash flow side, and I'll go more into the multifamily side. So the joint venture partners, or our partners, are actually getting 100% of the cash flow, 100%. So we generate nothing from a cash flow perspective. But the one thing that we do a little bit differently is we do charge a management fee.
Yes.
And that is based on the rent. It's on the rental income. So not much different as you would calculate property management charge. This would be called, or our company's called Prosperity Real Estate Investments. So we charge a Prosperity Real Estate Investment management fee.
Yeah.
And that management fee is to kind of manage the day-to-day operations and all that wonderful stuff. And really, for us, we need to be fed, and I got a family as well. And you're working really hard on this investment. You absolutely deserve to get paid for this. So
Do you charge an acquisition fee upfront?
we do. So we charge an acquisition and disposition fee as well. So in the time of acquisition, we charge an upfront fee. Part of that is just to handle all sorts of different expenses within the project itself, obviously sourcing it. We're also budgeting for a kind of a 5-year time frame in regards to travel expenses and all of those things. So that's part of that whole basket.
What is that? What does it work out to typically? How does that structure?
It varies. So from an acquisition fee, we can charge between 2% of the purchase price, 2.5%. On the management fee, that also tends to change, vary as well, depending on how much is involved.
Yeah.
So, for example, if we're looking at improving the whole cap rate of the entire building itself, but we literally need to boot all the tenants, do a bunch of renovations, I'll charge a higher management fee because there's just so much more involvement that's involved with that. And that can range between 2 to 4%, somewhere in that vicinity.
Right.
So.
And then same on the disposition, similar number?
Disposition fee about roughly the same.
Okay. So on that monthly, is it an administration fee that
management fee?
Management fee. Is it based on gross rents? And what approximate percentage is it?
It's between 2 to 4%. Usually, it's actually probably more 3 to 4%.
Okay, so let's say it's 3, just because I'm a simple guy.
That's
right?
fine.
But then all the other expenses and bookkeeping and the resident managers and all that other kind of stuff. That's all an expense line within that.
That's
so
correct.
it's a true 2% revenue stream to your company.
That's correct.
And quite frankly, that's probably for the amount of work that you have to do, because you have to have an admin team, and you have to, you probably have to do a lot of the travel and all that kind of stuff. It's a very fair thing to charge.
There's no question. Like I said, there's lots of stuff that's happening behind the scenes, and it's obviously discussed. Like, part of the things that you got the bookkeeper, you're managing all the books, and you got to make sure the statements are done at the end of the year, make sure everything's accountable and managed appropriately. Another piece that we also oversee is, and maybe a little bit different, but we are a big believer in our organization to constantly be keeping our finger on the pulse in regards to vacancies and rental market.
Right.
If there's one thing that we learned in this last year, it was exactly that. So we hired a social media expert as well, and that's part of the expenses under the Prosperity banner. And we'll charge some administration fees to our tenant or to our joint venture partners on these projects. But the reality is, we've got a person full time. That's all she's doing, is she's constantly communicating and advertising and working through the social media sides to be finding prospects and tenants.
Now, is this a new structure the way you did it? Because I remember before, and I could be 100% wrong.
No, that's okay.
You used to charge like a 12%, which included all those things, or was it always been this way where it's just kind of an on top of things, or do you prescribe either way? Like for example, let's say it was a charge of 15% total, which including that 15% was the bookkeeping, the property management, all those kind of things covered in that, and then you maybe made a spread between.
That's correct. Yeah, so that's exactly right. So that's correct. We used to charge just kind of a lump sum for kind of the entire basket of goods, and that was just a piece that was in there as well. So
you finding this new structure better?
Yeah, well, I think the important part is, when you start to see, say we call it an administrative charge, and just lump it all together, it can be a little bit easier to reference that. But I'm again, it's about having the doors completely opened up for our partners, and so they have clarity to it. I have no fear or afraid to say, hey, we're charging a 4% management fee on top of that, because we oversee that. And so again, our big component is making sure that we have.
There's something to be said, and I'm just speaking for myself. There's something to be said of having an upcharge to something versus just having, here's what the fee is. You pay the exact cost. No different than with your property manager. I don't like when a property manager charges you a 15% upcharge on top of the work that's already done. Those kind of things. And what you're just doing is you're providing 100% transparency that it's cost plus 3%.
Correct.
Is really what it is.
That's correct. Yeah.
So I imagine that has really helped you during some of the lean times.
No question. We would not be probably having this discussion.
You'd be having a job, a full-time job.
Probably, yeah. It would be a completely different animal. But again, it's the way we kind of managed it from the very beginning, and it's just ensuring that. And, there's going to be times that there's not going to be any cash flow, but that's still not to say we're still working. We're still working even harder than we've ever worked before, especially during the leaner times. And again, you still got to put food on the table for your family and stuff, and you got to look out for number one. And again, part of that is learning experiences from the very beginning, to be very honest with you.
Yeah, so. If you're starving, you're not doing your partners any justice.
Not at
You're
all.
actually putting their money at risk.
There's no question.
Because you have to do other things. You may even have to get another job, and you're actually not being a good steward for their investment.
Correct. And again, they've hired you, they've trusted you in their money. And for you needing to be doing something completely outside of the box, that's not really doing them a favor whatsoever, and it's putting their money at risk.
What would you tell to somebody if I'm sitting here and I'm scared to ask somebody for that extra 2%, and I'm just I'm just scared to do it. It's they've already put up $100,000. They've qualified for the mortgage, and now I'm asking them for a 3% fee on top of that. I'm scared to ask them a management fee. Well, an acquisition fee, a disposition fee, and a management fee.
Sure.
Ooh, I think I'm asking too much.
It's part of the analysis. It's part of it right from the very beginning. So it's just like any other expense, and we built it in as there's going to be an appraisal done. There's going to be an engineer coming into the property itself. So these are the expenses that are associated with this. This is an acquisition and disposition fee. This is a fee that's directly for us.
Yeah, the Mike Ponte professional fee.
And there's lots of costs that are associated with that, and we need to have that built in.
Right.
We talk about it very bluntly and upfront, and you'll obviously have some questions about it. But again, the whole point of the matter is having open clarity to exactly what it is, and they get it, they understand it. And if people are really squeezing you and negotiating with you and nickeling and diming with you, then I don't do business with them. It's just the reality of it. This is the cost of this transaction. If this doesn't work for you, I apologize. Maybe another deal will. Yeah. And if that doesn't work for you as well, maybe it's just better to part ways. And that's the reality of it.
Well, and here's the question I was going to ask after is it's probably only in your mind that it's an issue.
Sure.
When you actually fully transparent and present it to the person that's to your investment partner, they're probably going, yeah, it makes sense.
Yeah.
Have you ever had any pushback?
I've had pushback before. There's no question. And I've had pushback that people have said, what is this fee for? And really try to explain it. I'm like, this is one of the costs that is part of this transaction. And again, you're either in or you're out. And if you don't want to participate in this particular project, I totally respect that. And that's fine. But this will be incurring in probably future transactions. But this has actually been screened from the very beginning. And it goes back to the initial presentation. So when we go out and actually have that discussion at the very beginning, that one-page document references what are some of those costs and what to be anticipating when those costs when they come. So when you see a typical deal, these are kind of the typical things that tend to come. So if there is an issue, that will come up at the very beginning, and it should never really come up at the time of when you're about the process of transaction, because at that point in time, you've screened them, you've addressed a lot of their objections or any questions that they have. So it's very rare that I have that issue. Like I can't even, in the last 5 years, I can't even comment. I can't even think of one incident that I've had with it. But it is just part of the due course of managing your business. And
it during those ups and downs, it actually is. I think everybody should be paid from the property, because it changes your mindset around the properties. Right? Just imagine if you're doing it and you're doing it for free, and it's costing you, and it's a pain in the butt that you're having to deal with. You're changing a management company and you're doing all these other things. It has a different perspective if you're actually getting compensated for it.
There's no question. And it's even funny. I had one of my biggest clients actually. When first I just brought this to my memory again. But one of my biggest clients, I remember having this discussion, and he was like, I'm glad you actually have that in there, because I'd be questioning how, in their mind, and it's always in the back of their mind is, okay, where's the catch? What is it? Where am I getting screwed is the wrong word, but where is it that you are making your money?
Yes.
And you're telling them up front where you're making their money, so they can say and realize that, versus not disclosing that. So you point it out and you tell them exactly where it is. They either accept it at that point or not. But my biggest client said, I'm happy to see that, because that's what I wanted to see. Yeah.
Profit's not a 4-letter word.
Not at all. We're all in it to make profit. That's what we're there for. So.
And quite honestly, the way you described, you structured, it's a 65-35, and they get 100% of the cash flow.
Correct.
Do they get 100% of the cash flow until a certain time, or is it 100% of the cash flow until the disposition?
They get it 100% of the time for the disposition. Our only cost that we charge is the management.
And I would imagine the last couple of years, it's been a little bit of tight cash flow.
There's no question.
What about cash calls? How does that handle?
Cash calls have happened.
Is it a 65-35? What's the percentage?
It is a 65-35 75 split on
Yep.
on situations like that. Fortunately, one of our biggest rules of thumb that we try to reference is you always kind of plan for worst case scenario
Yep.
when it comes to the reserve funds. And like I said, it is a really important piece. But there was a key rule that we tend to always stay with is try, whatever your worst case scenario is, figure out what that number is and double it. And based on that, we had enough reserves to support some of the really thin times.
Yep.
And so to answer your question, yes, there was lots of cash flow issues, I would say, in the last year with higher vacancies and stuff like that. And then there was some circumstances that we've had to do some cash calls as well. And it's not an easy discussion by any means.
Well, during downtimes in the marketplace, you actually have to, it's unfortunate, but you actually have to spend more money to keep your places rented.
Yeah, and that was the tough part this last year is like, here you are, you're putting a bunch of capital into
To get lower rents.
Yeah, to get lower rents.
Yep.
You're renovating because there's so much inventory in the marketplace. You got to put new flooring and new painting and all sorts of stuff because, your tenants had a significant amount of choice.
Yep.
And if you didn't do that work, it was just going to sit.
Yep.
And that's really the catch-22 at the end of the day. You're putting more money in, there's no cash flow coming in, and the last and the worst is you're getting it for a lot less rent than what you were initially having before. So, to answer that question about the cash calls, the big piece, and I know I've highlighted this earlier, was it is about communication, and they need to have clarity to what's going on. So there really is no surprises about this. So, we used to have conference calls or meetings usually once a quarter. We've changed that to every 6 months now. And for those of you that are just getting started, I actually highly encourage you guys to meet with your clients every quarter. But we've just now got to a point where we just can't do that to the same levels we wanted to. So we've changed that a little bit. But saying that, we had those discussions at the very beginning and just be very upfront and show some numbers and saying, hey, things are not looking good. We're struggling here and this is the situation. So there's really no surprises versus you coming to them last hour and, if they haven't heard anything at that point and then all of a sudden they say, you come to them, hey, I need a check for $2,000 or $3,000 because this thing's been vacant for the last 3 months. You want to make sure those lines of communication are constantly open so they understand it. And in some cases, you're prepping them for the worst case scenario. Right.
And you also had a chance in the last little while, too, to also take some advantage of some refinances to keep that cash. And you were just sharing, you have the really nice position where you actually have more capital available than options at the moment.
Yes, correct.
Right? So, guys, you will get to that point. Trust me, there will come a time, and you can send me a thank you note at that time that you're sitting there, you don't believe it now. Because you're sitting there going, geez, I need the capital. I need more. I have so many opportunities. There will come a time where you will have more money than you have actually opportunities.
That's correct. It's so true. And I remember the very first time trying to raise capital and getting my first client, actually. I remember that very well. But it was just such a success, such a big thing. But I think about all the time that I had previous to that. So again, those 30 calls, it was just an absolute grind to it. And then to your point, you get that one deal, then you get the second one, and then the third one, and then it starts to kind of just snowball. And then once you start to work the whole referral side of things, it just starts to come, and then you get to a point where you're just like, I can't really take too much. And, for those of us that have been doing this for a long time, I will guarantee you most of us are kind of in that same position where it's like, you've got a lot of capital, you've got people that are wanting to give you money, but now the biggest issue is trying to find some of those opportunities.
Right.
And I guarantee you, if you stick this thing out, this is exactly going to happen to you as well. So.
And it was just part of the process.
It is.
You would have not been to this level of success now unless you had those 30
no question.
3-hour conversations. I guess the real lesson here is talk to your wife sooner.
Yeah. And listen to her.
Listen.
I think that's even more important.
Dawn, if you're listening, come on, step up. Dawn's probably going, I just have to let Mike go his own path.
Exactly. Yeah.
Couple other things though. We were in one of our last lunches. You were talking about a wonderful way of how you handle your paper flow and your bookkeeping. And we're gonna do an entire module on organizing and book flow. But you have a wonderful system. You work with your accountant and your bookkeeper.
Yes.
How do you just maybe describe that a little bit?
Sure. So for us, we tend to do our quarterly statement. We do statements usually on a quarterly basis.
Quarterly basis, not once a year when a shoot box. Right?
Correct. So we try to keep it really simple. And the way our system works is all the financial statements. So when our property managers all throughout the country, really. They will send us an email of all the statements, which goes directly to our bookkeeper. Our bookkeeper actually has access to a lot of our accounts. And one of the things that we tend to have is we have a separate bank account for every single property that we have. So we know all the puts and takes within that account. And so our bookkeeper tends to load everything up. And if there's any expenses or something of that nature, or any surprises that the bookkeeper may or may not know what they are, there's a program that we use is called HubDoc. HubDoc.
Okay.
And so for those of you that are wanting or working with the bookkeeper, they may not use this program, but it's a wonderful program because everything's kind of loaded up into this online platform. And if, say, for example, there was an expense of $100 for advertising that I've cut a check for,
or Mike buy me a coffee after,
or
it's
whatever the case
after.
may be. So I've kind of loaded up into the HubDoc file. It goes directly to our bookkeeper. He loads it up accordingly. So it's a really clean, simple process. But the real nice thing is it's completely hands off.
It's 100% digital too.
It's 100% digital. So say, for example, I just bought you a cup of coffee and I just had this meeting with yourself. I'll take a picture of the receipt. It loads up to HubDoc. And automatically, I can put some notes into it real quickly, but it happens instantaneously. So I can do it right then and there, load it up. So again, to your point, I don't want to have that shoebox at the end of the year because it's just too much to deal with. And it's okay when you first start buying your first, second, or third property, and you'll see lots of people do this. I was one of them. I started to do my own financials,
your own bookkeeping.
And you know what? I'm not going to say you shouldn't do that because you know what? That was great learning for me. A ton of learning from understanding the business side of your investment. But you will get to a point where that is going to be your biggest dog, and the biggest challenge for you is constantly maintaining that every single month, or even worse, if you're trying to do it on a quarterly basis and trying to remember what happened 3 months ago, and if you're managing even 6 or 7 properties, it does get lost.
Right.
And really your focus, if this is the direction that you want to go, your focus truly should be either finding investment partners, or secondly, finding properties and transactions. And all the administrative stuff, you're trying at some point in time to funnel it off to other people.
Right, being the owner of the business.
Absolutely.
And I tell you, I guarantee that having those quarterly statements to investment partners probably really instills even more of that trust and confidence in you.
That was kind of my comment earlier is when you've got those statements ready to go, and we tend to always say, third week of the 4th month. And so it gives the bookkeeper enough time just to make sure, it gives me an opportunity to check everything's accurate, and then we start to present to our potential joint venture partners. But when we actually used to do this, we used to meet with them personally and provide them the financial statements of the property and also a summary of the bank statement. And you review that with them, and sometimes there's bad, and sometimes there's lots of good. And but it's funny. I can think of one story is I was sharing some pretty bad news actually one time, and vacancy. I think we had a vacancy for 2 months. And I'm like, the property's been vacant for a couple months. There's going to be no cash flow for this coming quarter, just because we're building on the reserve funds again. And the individual's like, yeah, that's fine. That's great. So what other deals are you working at? And
I was just about to say, have you ever had them re-up or bring you a new referral during those meetings?
Always.
Every time.
So my comment is, and that's a great statistic by our company, is we don't have one investor that only owns one property with us. They own multiple. So, and I take a lot of pride in that because it shows that we've really worked hard and we've really tried to provide a lot of benefit to them. But the biggest part is just trying to as much transparency as we possibly can.
So I hope you guys heard that. What Mike just said is what some people consider a big pain in the butt process of getting statements and getting that out to people. You actually turn that into getting more capital and also more referrals.
No question.
Right. So it's just a matter of reframing it and just getting the job done.
Absolutely.
So do you see why I'm saying this guy is a fantastic operator of his business?
Thank you.
We have one more segment we're going to do. We're just going to wrap this up here a bit. And as well as you maybe have heard in the background, I have a dog. I think that needs to go pee upstairs. So I'm going to go check on Scooby here shortly, and I'll be right back. This is my good friend Mike Ponte, and we'll be right back, guys.